Hello, everybody. Welcome to Facebook Live Thursday. I have special guest, Ace Mortgage Broker, Keaton Kirkwood from KB Mortgages joining us. And the reason we asked Keaton to join us is number one, because he's a heck of a great mortgage broker. And number two, he just took time to write an incredibly intelligent and insightful article about what is on everybody's mind, which is interest rates going up and then going up again, and then going up again, and then maybe going up again after that. And so we know this is on everybody's mind. And there's a very specific thing that I want to talk about with respect to mortgage rates, which is something every single person who already owns a property is probably thinking about, which is, do I ride that variable or do I lock in? It's a big question. There's math involved with it, as I'm sure you can appreciate. And while it's easy to make an emotional decision and just say, oh, I want security, I'm going to lock in, there's actually a lot of thought, calculation, and knowledge that goes into making a smart decision. And I'll be the first to admit, I am not as smart as Keaton when it comes to those kind of decisions, which is why he's here. So Keaton, welcome to Facebook Live Thursday.
I appreciate it, James. It's definitely one of those things that I'm getting a lot of questions about right now. We get this cycle of rates go up, news articles jump all over it. Rates go up 200%. Of course, they actually just went up a little bit, but they like to play the numbers. That's what the media does. People are getting stressed out. People are freaking out. The lucky ones are reaching out. We're going through it. The unlucky ones, I hear about what they did that we can't take back. They just made a knee-jerk decision. They locked in. They did something they probably regret 2 years from now, but we'll get into why that's the case.
Of course. So we're in the same boat. Our clients, our past business opportunities, everybody we're working with, people are reaching out. We're real estate experts. Keaton, you're a guy that produces a lot of mortgages for a lot of people. And those people who have mortgages want to know, what do I do? It's a very uncertain time. And of course, the media is going to get us all worked up. That's what the media does. It's their job. And so we're talking to a lot of you guys out there. We know you're worked up. So I want to ask the question. Keaton, can you give us a little bit of recent history? Like let's wind it all the way back to the start of the year, January. What's happened since January to mortgage rates, just to refresh everybody who's tuning in?
So we were nice and steady January, early February, and then March rolled around, and in 35 days we had fixed rates go up 1.3%.
Wow.
Plus or minus 0.1. And we were seeing rates in the low to mid twos. Now we're seeing rates in the low fours, high threes. So the problem with that is that people go, oh, and they freak out, and then they want to jump into locking in, but it's too late. It's already done. It's already smoothing out. We're seeing the increased plateau, and we've seen lenders shrink variable discounts. So what happens is when you get a variable mortgage, a new one at least, or you lock in, they give you a discount off of prime. So not only is prime going up, we've seen two increases, one for 0.5% and one for 0.25%, but they're also shrinking the discount you get off that higher prime. So we've seen overall a tightening of rates in the market on the lending side.
Yeah, that's a real kick to the old keister, because not only is prime going up, but the discount. So you guys, when you get your mortgages, they always talk about, oh, it's prime minus this, prime minus that. For those of you that have been around a while, there was a good period of time a few years back where a variable rate was actually prime plus. So, I remember when we flipped the scale back to prime minus, that was a day of celebration for all of us in the real estate game. But Keaton, so the interest rate has gone up, prime has gone up by 1%, or has it been 1.25%? I just want to make sure we got the.
No, it's gone up 0.75%. So we had an increase for 0.25% and an increase for 0.5%.
Oh my gosh. So we're having a big old scare over 0.75%. But that's not all. Like, how much more are we expecting? And I know you can't predict the future. So what's the range? At the low end, what are we thinking? At the high end, what are they talking about?
So I think the most important first question is, why are they doing this? And there's the inflation topic, which you can go on and on about. But I think what really matters to us is they're trying to also cool the Vancouver and Toronto markets a little bit. So what I think we're going to see is a really aggressive short-term approach where we've already seen a 0.25% increase and a 0.5% increase. The 0.5% is the first time they've done that, I believe, in 15 years. So they're really trying to show a strong hand. What I realistically expect is we're going to see another 2, maybe 3 increases over the next year, 2 years. It's really going to depend on how the bigger picture plays out. But the big takeaway is that I think they're going to talk strong and they're going to try to get people to react with as little increase as possible. Personally, I think things are going to plateau and then we're going to end up in a teeter-totter. It's going to go up a little, it's going to come down a little. It's important to know that we're still at interest rate levels that are equal or slightly below what we were before COVID. So rates have not hit some crazy, scary level. No one was really freaking out in 2019 before COVID rates dropped.
Yeah.
We essentially had an interest holiday where, thanks to COVID happening, they lowered rates and everybody got a really, really good deal.
Yeah.
But the sale's over.
You know what? I think that's a very insightful point, is that, you know, everybody says, oh, I just wish things would go back to normal after COVID. Well, we're going back to normal interest rates and now everybody's belly aching about it. But this is what going back to normal looks like, folks. So it's not a call for panic at the level that potentially some of you are feeling. And that's a really great point, Keaton. So, okay, so that's our context. The reason that this is happening is they're trying to just cool the market just a little bit, return interest rates back to a place that's more normal as far as the last, 10 to 15 year history of interest rates go, and get things to a nice equilibrium where interest rates and market are balanced. It's not an exact science, which is why we're going to get the teeter-totter that Keaton described, but that's what's happening. So the first part of our conversation is what's happening. The part of the conversation that most of you are tuning in for is, what do I do about it? And that's why Keaton's here, to help talk to us about what do I do about it. So that's where we're going to enter the conversation about locking in a fixed versus letting your variable ride. So Keaton, let's talk a little bit about that question. I know it's a complex one, but what factors should a consumer take into consideration when trying to answer that question for themselves?
Well, you have to start with your situation. Are you already in a variable product and considering locking in? Do you have a renewal coming up, or are you buying? The answers will be similar, but they're going to change the math just a little bit. But the important starting point is, what is your variable option? Prime minus something. And then you have to look at, what are your fixed rate options? So I actually ran an analysis of a 2.6 variable. So that is a prime minus 0.6 discount. And this is factoring in after the increase last Wednesday. So I compared 2.6 variable versus 4.14 5-year fixed. Now, for the variable rate, an important question is, how many increases do you need to see for your interest cost to break even over the next 5 years? Simply, if you have an option of a 4.14 fixed, simply having variable rates go beyond that in 5 years does not mean variable is the wrong choice. And this is where a lot of people go wrong, that they assume, oh, if it goes above, I lose. But that's not the case. When you take a variable, you're saving money initially because you're below the fixed rate. As variable rate increases, your savings are going to slow down, slow down, slow down. At some point, your variable option is going to hit, let's say, 4.14 plus or minus a little bit. At that point, your savings stop. So let's imagine you've saved $10,000 over 3 years because you started lower and rates gradually rose. There's 2 years left in your term. Rates would need to then go beyond the 4.14% fast enough to erode your $10,000 of savings before the 5 years is up. Now, I ran a couple scenarios, and it's in the article. There's the math behind it. There's a tool for you to play around with your scenario. But it would take, so we've already had 3 increases. It would take a further 8 to 10 increases, depending on how fast they happen, for a variable product at today's rates to exceed the fixed rate from the perspective of your average interest cost over 5 years. Because that's what we care about. Not what are you at the very end, but what was your cost over the 5 years. To further push for variable, if you take a 5-year fixed product right now and we do see rates decline, the variable person is going to benefit from that. The 5-year fixed person is going to have a penalty that is 900% larger than the variable person. That's an important thing.
Huge perspective on that. Yeah. Can you just explain that one in just a bit more detail? Because anybody thinking about starting a new mortgage with a game plan to potentially move, upsize, downsize, reposition, sell, Pay attention to this one.
So over 50% of Canadians break their mortgage in an average of 42 months. So over half of Canadians break their mortgage before the term is up. Now, a variable product
What's
is
the
going
most
to have
common reason people have for breaking their mortgage? Because breaking the mortgage sounds way more intense than what it actually is.
breaking mortgages, you move and you can't port your mortgage.
Yeah, exactly. You sell your house, so you discharge the mortgage. That's all that means, folks. It doesn't mean the bank's breaking you.
Well, it means more than that too. It also means that, hey, rates dropped and you're in a situation where you're at 4.14%. Rates are now 3%. You want that savings. You don't want to lock in that extra percent for the next 3 years.
Yeah.
So then that's when the penalties come in, analyzing, is this a good time to change your mortgage for a positive reason? Do you need to renovate? Are you buying an investment property? Are you selling an investment property? The reasons are way beyond what most people think. And that's why we see such a high percentage of Canadians breaking their mortgages.
And so why does it make more sense from a breaking the mortgage perspective, a variable rate instead of a fixed rate?
So 99% of variable products have a penalty that is 3 months interest. It generally works out to be about 0.4% of your mortgage. Depends a little bit based on your rate and the lender you have, but you can expect that. Another way I look at it is it's roughly 1.5 months payments. Whereas the fixed products have a penalty that is either 3 months interest or an interest rate differential penalty, whichever is greater. The really simplest way to think of an interest rate differential penalty is, roughly speaking, how much interest is left on the mortgage. That's often how the calculations work out, and we see them range from anywhere from 1 to 4% of the mortgage balance, sometimes as high as 8 or 9%.
That's a lot more than the 0.4 we were just talking about from variables. So yeah, way bigger penalty if for whatever reason you need to break or reposition your mortgage. That's a massive advantage of variable that doesn't get talked about nearly enough. So I'm glad you brought that one up, Keaton. So I want to circle back because again, the question is, should I lock in or let it ride? Well, Keaton, if I can paraphrase what I heard you say, it's that for a good chunk of time, the variable rate is going to be lower than the fixed rate. And then you're going to hit this little point in the old middle of the timeline where now the variable rate's higher than the fixed rate for a bit. And what I'm hearing you say is, in most cases, when you add up every single month on that timeline, when you average it all out, the variable rate does better for you big picture wise over the 5-year term than a fixed rate does, because that equilibrium point almost always favors the variable rate.
Yes, historically, variable's been cheaper than fixed. Likely moving forward, it will be. Not guaranteed, but likely.
Yeah.
You would need to see more than 8 to 10 increases over the next 5 years for variable to tip the scales.
And are they even talking about 8 to 10 increases, or are they talking about fewer?
It depends on who you ask. Now, it's important to note that the people who talk about this are the economists that work for the banks. Banks make significantly more money from fixed products than variable products. When people lock in, they're typically a captive audience. The margins are far greater for a bank. They make more money when their clients lock in from variable to fixed. So there is a financial incentive to really hammer the point home. Ultimately, I don't think anyone knows. It's how can you predict what's going to happen in the next 5 years?
Yeah. So I guess the thing to do is you've got this handy dandy calculation tool that you made so that anybody who is thinking about switching from their fixed to maybe locking in for the variable, it basically does like a scenario analyzer where you can say, okay, if I do variable, this is what it'll probably look like. If I do fixed, this is probably what it'll look like. And then, our viewers can make an informed choice, because, it's like, that's right. Keaton, that's what the tool does.
Yes. It looks at a scenario of 8 increases or 10 increases over different timelines.
Cool. And so, guys, if you're watching, it's math. It's a financial decision. It's business. The numbers won't lie. So I know that, for those of you out there who are like, oh, the increases, this is scary. My heart can't handle it. My gut says lock in for the security. That's an emotional decision. We're emotional creatures. We're human. I get it. But if you want to make a smart business decision, use a business tool that allows you to crunch the numbers. And if the numbers make it look like riding your variable is a better option, well, there you go. And obviously, again, disclaimers all around. We can't predict the future, but it's kind of looking like it's more likely that you're going to see a better outcome riding your variable than fixed. With the caveat that, like, check out the article below. We've got the link in the description. Use the tool, run your analysis, and make a smart business decision for your asset, for your mortgage, for your financial future. And make sure in the comment section you say thanks, Keaton, because he took a whole bunch of time out of his schedule to spreadsheet it up and build that really cool tool. So Keaton, I appreciate you joining us for this discussion on Facebook Live Thursday. And on behalf of everybody watching, I appreciate you taking the time to build that handy dandy tool, because that's going to help a lot of people get clarity in what is kind of an uncertain time.
Thanks, James. I appreciate it.